Hello, everyone. I hope you enjoyed your long weekend. Obviously, stocks didn't really enjoy their long weekend that much because at one point last night, the futures were up 1.5% across the board. And as you can see by the end of the day, it was another above average volume sell off for the NASDAQ. Another clear, it's not a distribution day because volume is lower than the session before, but if you look at the volume surge of how well above average it is, you can just see that it's just, unrelenting selling. Our high of the day was where we opened and we just didn't do anything after that. So pretty ugly if you look at the NASDAQ. NASDAQ 100, a little bit better, only up 0.14%, but the same kind of intraday reversal that I'm talking about. NYSE, similar situation, only up 0.02, but the intraday reversal is not good. While there is a intraday hammer back-to-back days, still, it's nothing that impressive. But technically, yes, today is day one of a rally attempt on that index. S&P 500, technically, today is day one of a new rally attempt. Volume wasn't heavier, so no accumulation. We closed lower than where we opened, so it's hard to get really too excited about this right now. Dow Jones Industrial Average, same thing, only up 0.17%. The Russell 2000, even worse, down 1.28%. I keep telling you guys, you want to see the Russell 2000 Dow Jones Transportation Average leading, not lagging. Finally, on Friday, they didn't sell off as much as the regular market, but once again, on Monday, the Russell 2000 had another ugly day. The Dow Jones Transportation Average, not as ugly, but still down 0.48%, which is worse than the NASDAQ. So the Dow Jones Transportation Average was the second worst. The Russell 2000 was the worst. As long as we have that pattern in the market, it's going to be hard to get too excited about anything here. So right now, strong downtrend. Sucks how it started with all the gapping around, which made it hard. Fake out, almost breakout to new highs in December made it even worse. Then all the volatility that finally led to the gap down break. And it's just been very hard to game on an end-of-day basis. If you're looking for alpha, you got to go for those early morning spikes. AEZS was another one today, and XTD was another one in play, and that one kept on going into the end of the day. So once again, we were focused on them. These pre-market gainers in XTD, you can see gapping up. AEZS, you can see gapping up. They both spiked in the morning. If you're not playing the low price stocks intraday in the morning for spikes in January with the January effect, I don't know how you're really outperforming here on the upside. So you got to stick to the short term. Now, end of day basis, SWHC finally closing below the 50-day moving average. I listed it as a 50% sell because it's closing below the 50-day moving average, but with the lower volume, it really isn't. So I'm going to go ahead and take it off. Like I wrote it down in my book, but still, it's something to consider here with it closing below the 50-day moving average. So now if it moves below 1980, in my opinion, you want to be out half of it. If it closes below 1980 on above average volume, it's a full sell because SWCH on an end-of-day basis is only like about a 5% gain right now. But the close below the 50-day moving average isn't a good sign considering how much it's reversed off those highs. Remember, back here, I said SWH and RGR probably putting in a topping candle and with the volume surge, and of course it's worked perfectly because this is a poor market. On an end-of-day basis, two more speculative stocks give a full sell. HBCP already completely out, and GSV I never even got long because I was fully invested back here when the signal produced, in both accounts leaving me in a no-win situation, so I couldn't get long this stock. And at first I felt like an idiot, but look at how long it took to get these gains. Okay, so from the time that we went long, which would have been here if I would have gotten long, we would have had a 23% gain. And this is why in small cap stocks that are pieces of shit that we go long that are under $5, if they make a 20% gain, you got to start looking at taking profits off of it. I mean, obviously a 50% sell signal came back here, so you were able to lock in some, with right around a 5% gain because the damn thing gapped down the next morning. Wonderful. But now it's a full sell, just showing that nothing's working. So not even a hedge in a gold position is working. So this is a very, very rough market. Treat it that way. The only interesting thing out there are utilities. XLU. I'm going to try to bring up all these that I see. SO, ED, NEE, OGS, AWK, CMS, XEL. That's the hot sector, utilities. So that tells you all you need to know about this market. And on top of that, there's been some real estate stocks that have been looking okay, PSA. And do you remember our OUT? We went long back here because it looked like it had a bottoming candle with the volume and BOP surge. Failed immediately, but small losses. Well, it tried to have another day on the 14th, big volume surge. BOP actually surged a little with a pocket pivot point signal. Had a good intraday session on the 15th on Friday. Big intraday reversal, closing higher than where it opened on above average volume, keeping that green BOP. Well, today it surged on even larger volume, the largest volume in 2016. BOP surged significantly, and we got another pocket pivot point signal. So even though this is a speculative name, with this being I think the dividend's 3.6 on this, and like the other long we're going to show you is like got a dividend of 6.3. They're like inverse of each other. But with OUT being a more defensive area stock, it looking like it's bottoming at these October lows, the surge in volume and BOP along with the pocket pivot point surge, I think a new long is warranted here. What I would do is want to see it move higher immediately. So if it doesn't move higher immediately, cut your first half of your losses with a move below 21, and then your final sell stop can be below 2027. So on the entire position, if you just use the final sell stop at 2027, you risk a little over 6%, but I'm keeping this small. This is only going to be 0.5% of my account value. Why? This isn't an uptrend. We haven't gotten a clear follow-through day yet. If this signal comes after a follow-through day, sure, 1 or 2% even, because we don't risk a whole lot, and I know that I have the market on my side. Right now, the market's not on my side, and even though this is a very nice short-term pattern, this isn't the kind of pattern that, I really want to, take a lot of. I just like it on the very short term. I like the strength in this market, so I'm willing to put 0.5%. But remember, we're still operating under a sell signal, so you gotta, tread lightly in a tape like this. But it looks like it's bottoming, so it's good. And then the best long of the night, initially I thought was a CanSlim quality name, but evidently earnings were released on the 4th in January. And unfortunately, that caused it to just slip out of CanSlim quality. So the EPS rating is 69. What I consider CanSlim is a 70 EPS rating. Relative strength is in the mid-90s, like 95 or whatever. But once again, just like OUT, pocket pivot point signal, volume and BOP surge. The next day, decent price action, not great, because if you would have taken that signal, with the pocket pivot points, and you would have used the low a day of 1840, well, let's look back here. Yep. If you would have used 1840 the next day, you would have been shaken out because it traded down to 1832. But since that wasn't the long signal, the good volume surge, the good intraday reversal, and BOP growing, the very next day today, another BOP surge from actually a significant looking BOP surge, volume surge again, another pocket pivot point signal. So it's basically like a confirmation move, just like OUT. 2 out of the past 3 sessions, pocket pivot point signals, confirming holding the lows, strong BOP and volume surge. So EBF and OUT have the same similar situation. EBF has a 6.3% dividend yield. And while OUT is something like ranked 88th in its group overall, EBF is number 1. So EBF is a little bit higher quality than OUT. So even though both are really just price volume BOP surge scan finds, OUT will remain 0.5%, EBF will be 1%. If this was still a CanSlim quality name, it would be 1.5%. But instead, how I'm looking at it is old CanSlim name, give it a little bit of credit there. It's basically acting like an earnings winner, and it's building out a daily short-term chart pattern like an earnings winner with the green BOP, the strong volume post-earnings, and the pocket pivot point signals. So I'll give 0.25% for each of those, being an ex-CanSlim, being an earnings winner, and then 0.5 for being price volume BOP scan worthy. So 1% is going to go into EBF, 0.5% is going to go into OUT. Both of these stocks, the line in the sand is very clear. If the volatility continues, what the hell am I going to do? There's nothing I can do. I just got to suck it up. But EBF closes below 1832, we're out. We don't risk more than about 3.25% there. And OUT, once again, if it closes below 2027, we're completely out. You risk about 6% on that trade, but with 0.5% of the account margin, it's not a big deal. Now remember, if you do not have a large account balance, which is what I consider at least 6 figures whenever you're trading with so many positions, and or you do not pay have cheap commissions, I consider cheap anywhere from $1 to $5 per trade. EBF and OUT might not be for you, and if you have to pick one or the other, clearly EBF is the higher quality name since it's basically a borderline CanSlim stock and it's already in an uptrend and it's number 1 in its industry group.